Welcome. My name is Rao Garuda, and today I wanted to talk about something that majority of the high-income earners in America have, and it's a plan that's not limited only to people at the highest level, but also to many people at many different income levels. My name is Rao Garuda. Welcome to Meaning of Money. It's called a charitable remainder trust. As I'm very fond of talking about the tax code, the US tax code has 72,000 pages, and it's scary because most people don't understand why we need such a complex tax code. But there are two very important words in the tax code that everybody needs to understand. One is called control, the other one is called ownership. If you own something in your name, you have to pay taxes. If you control something, you don't have to worry about taxes. So what a charitable remainder trust does is give you exactly that control. So basically it works like this. You move some money from one pocket to another pocket. And the one pocket that you currently have it is in your own name, right? So all you're doing is you're changing that to another pocket, which is called your charitable remainder trust. It doesn't mean that you have given away the money to a charity and you lost control or you're going to go broke. Because there are two things that happen immediately after you make this move. The first thing that happens is you get an income tax deduction. Depends on how old you are and how long do you want this trust to last. And more importantly, this trust will give you income, let us say 5%, every year for the rest of your life. Your question may be, okay, this sounds good. What about my spouse? The answer is yes. She's also entitled to income as long as she lives or he lives. So to keep it simple, if you move $100,000 from your one pocket to another pocket called charitable remainder trust, you still control that money. You can invest that money for the rest of your life, and you're also entitled to income if you want it or if you need it. Either way, it doesn't matter. If you don't need it, you can say, I will take an IOU. In other words, suppose you didn't take income for 10 years. That means you can take 10 years times 5%, which is 50%. So you're entitled to ask $50,000 from your own trust. By the way, you don't ask anybody. It's a tax entry. You can just make yourself a check for $50,000 that you did not take for the last 10 years. This may come in real handy, especially if you're working right now and you don't need that income. So it could act like a pension plan in the long run. But the main thing to understand is for the rest of your life, or as long as the charitable remainder trust is in place, the money grows tax-free. And when it grows tax-free, there's no tax and no impact on you personally. That's the reason why most of the affluent people in America have a charitable trust or a charitable remainder trust. Now, what does the remainder mean? It means that after you pass away, and your spouse passes away if you wish, you can stop the income, and the remainder can go to what is called a family foundation. Now, everybody has a family foundation. I'm sure you heard of Gates Foundation, the Buffett Foundation, the Rockefeller Foundation. There are thousands and thousands of foundations. The tax code encourages you to give to charities. So after you pass away and the money goes to your family foundation, your children now can control this money and they can invest this money. However, they have to donate at least 5% per year to a charity of their choice, not your choice. One of my friends is very fond of telling everybody that everybody is very charitable because you're writing a big check to a charity called IRS, right? Now, just think about it. If you could control how your tax money is going to be spent, or how you can control your tax money, the way it's going to be spent, at least part of it, would you like that? Almost everybody says, yes, I'd like that. So now you have it. A charitable remainder trust to control your money for the rest of your life and to control where that money is going to go even after you pass away, and for your children and grandchildren and great-grandchildren even to remember who you are. then a charitable remainder trust, which becomes a family foundation, will be in place until all the money inside, is completely exhausted, which may take many generations, because all you have to do is beat a 5% return, which is not that difficult if you invest in the market properly and if you're in good hands. Obviously, what can I do with the tax deduction? Well, we're fond of saying use the tax deduction to convert some of your IRA to Roth IRA. And we'll be talking about that a great deal in future videos. So if you like this, please give me a thumbs up and click on the link and let us know so that we can send you more material or alert you if we have new videos. Thank you very much. My name is Rao Garuda, and it has been fun connecting with you this morning.